The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Stocks in a holding pattern as volume plunges ahead of the Christmas holiday. Live from Studio 2 here at Bloomberg headquarters in New York. Merry Christmas. I'm Romaine Bostic.
And I'm Katie Greifeld. We're kicking you off to the countdown to the close on this Christmas Eve. And we actually have a lot of good news to talk about. The S&P 500, we are set to close at an all-time high, higher by about 0.4%. Big tech also seeing that upside bid today. The Nasdaq 100 higher by a similar level. All quiet when it comes to the bond market. The 10-year Treasury yield pretty much flat on the day, though the level's a little bit elevated here at 416. And then you take a look at gold. I talked about records in the S&P 500. More records when it comes to gold right now, higher by about 1%, Romaine.
Yeah, a phenomenal run that we've seen this year for gold and silver. But you come back to the broader markets and the economic data that we got today, which is actually once again leaving investors a little bit split as to where markets go and what this means for monetary policy. On one hand, you have an economy expanding in the third quarter at the fastest pace in 2 years. Resilient consumer, resilient business spending. On the other hand, a lot of skepticism about the reliability of that top-line GDP data and concern about income-level disparities in the consumer spending numbers, angst over separate data showing U.S. orders for business equipment down way more than forecasts, and industrial production restrained by weak manufacturing output. But that mixed economic picture, that's been the story all year. On top of that, though, complicating matters is a fifth consecutive monthly decline in U.S. consumer confidence. It was a somewhat surprising reading, too, because economists were expecting confidence to actually rebound after that government shutdown. But consumers are still worried. They're worried about inflation, about tariffs, about politics, concerns that for most of the year have kept that consumer confidence index stuck around some of the lowest levels since the pandemic. So with those economic question marks and the elevated market valuations, net positioning right now in equity markets, believe it or not, is actually now back down to neutral levels to close out the year, at least according to Citigroup strategists. But hang on, Scott Wren over at Wells Fargo Investment Institute, he says investors should heed the positive trends in place, like stable economic growth, stronger corporate earnings, and Katie Greifeld, the high likelihood that inflation actually moderates.
Well, that all sounds very good when it comes to the economic front, but let's take a look at the valuation picture when it comes to the S&P 500. You're taking a look at the S&P 500's long-term PE ratio. We're pretty much knocking on the door of 40 here. You compare that to past episodes. This chart goes back to 1996. I was 3 years old, continuing on yesterday's theme. But the last time we were at these sort of levels, it was the summer of 2000. You can see that the S&P 500 here in blue, we reached those heights, then we went down. Then you go to about 2022, which is that's when the Fed really started hiking interest rates and the market started to price it in. That blue line went down once again. And that brings us to the end of 2025. We're at these levels closing in on 40 once again. And there's a lot of questions about what that blue line will do in 2026, Romaine.
Brian Mulberry joins us right now to kick us off to the close. He's Senior Client Portfolio Manager over at Zacks Investment Management. And Brian, I do want to start there where Katie left off with this idea of valuation and honestly the idea of whether you see 2026, the equity market being a little bit more driven by fundamentals or whether it's still going to be driven by some of the hopium and some of the technical levels that pushed us higher this year.
Yeah, absolutely. I think the two biggest drivers of the market this year continue into at least the early part of next year, which is the hope that rates continue to go lower and the CapEx spending in AI infrastructure continues to actually go into the ground. You see that momentum that's been driving up that valuation, and that's because we have really large amounts of dollars, that huge spending, that CapEx of AI, that's all been announced. And so since that's public knowledge, that gets priced into the market where we are today. As long as all of that CapEx actually happens, the money gets spent, and we start to see dirt getting moved and data centers getting built and adding capacity to the power grid, you could see how you would have that momentum stay in place as it starts to feed into earnings outside of just the technology sector that's been driving the market over the last year or two. The problem is all of that CapEx might not actually happen. We're roughly $2 trillion over the next 3 to 5 years. That is an absolutely huge number, and roughly half of the GDP report that we saw this morning is that AI infrastructure spending. All of that has to go into the ground exactly at the right moment and exactly the right order in order to continue that high momentum, that high PE valuation that we're looking at right now.
And that's a great point, particularly on the idea that a lot of these big numbers, these hundreds of billions of dollars in investments, these are still commitments and not necessarily actual cash in hand or shovels on the ground, as you say. But it gets to the idea, Brian, as to whether you see fragility in this market, because if we do get any sort of sense of a delay, like we got a couple of weeks ago, there was a big report that Oracle denied, but that Oracle was somehow pushing back by about a year, a big project that it had been working on in southeastern Michigan. If we have that kind of fragility in the market, what does that mean if we do start to see material delays?
Well, in a word, volatility, because that's exactly what we got in that very example that you're speaking about. Oracle stock obviously having a meteoric rise and then a really rapid fall based on that loss of confidence, right? So if we don't see the money actually being spent and the growth in AI doesn't really happen the way that it's projected or the way that is currently priced in through the momentum of the market, then in a word, we just simply see more and more volatility. That's probably likely since we're seeing more competition increasing. It's not just that the Mag 7 are competing with each other. We're starting to see other startups come into the space and really start to show that there might be more efficient ways to train large language models. Maybe we don't need as many data centers that are currently priced in to where this market is currently valued.
And Brian, how do you see that volatility being expressed? Does that result in a higher VIX? It feels like we've been watching that all year, pretty stubbornly low. We get bouts of index level volatility. They never seem to stick around. Where do you see that volatility actually manifesting itself?
Well, actually, we see it manifesting in the fact that a lot of investors simply are de-risking their portfolios. When we look at investment styles in terms of growth versus value, large cap value has been outperforming large cap growth by over 5.5% in the last 90 days. Now, it was a rebalancing, if you will, in the Russell 1000 value where they included names like Google and Meta back in June. And Google's had a really nice run, up 25% in that 90-day period. But names like Eli Lilly up over 40%, and Merck is up over 30%. So we're seeing a rotation of risk right now as investors are moving away from large cap growth and some of these Mag 7 types of names into places where are a little bit more fairly valued. And all of the stock market is going up and the VIX is going down. We are seeing a rotation, if you will, in the investment style that's very measurable right now.
Yeah, no, it's a good point. That rotation between growth and value, it has certainly been dramatic over the past couple of months. I want to go back to the chart that I was showing at the top of the show. You think about the S&P's 500's long-term PE ratio. We're looking at heights that we've really only been at about 2 times or so in the past 3 decades. And I wonder what that means to you. We hear time and again that valuation is not a great timing tool. It's not something that you should, time your trades off of. But even still, how do you factor it into your outlook for the year ahead?
Well, we want to sit there and take a look at quantitatively how can we actually build up to this type of evaluation. And again, the answer is we have a lot of money. That $2 trillion that is committed capital is how you get to this type of evaluation. All of the market is simply assuming at this point that those dollars get invested as promised right now. The problem is the market in the business community is a little bit different. As competition increases, more and more attention is going to get paid to the monetization. So we've got a lot of capital investments in infrastructure, but when does that money come back to the balance sheets of these companies that are building out data centers? And when that capital does come back in the form of revenue, is it profitable? So it all comes down to earnings and earnings growth into the future. For the Mag 7, we think it probably continues to be fairly positive, much better than the S&P 500. So again, continuing that positive move and momentum, but there is a point where it starts to level off. The rate of growth, especially for somebody like NVIDIA, starts to top off. And even though they're a big company and they're very profitable, the momentum starts to slow.
All right, Brian, got to leave it there. Brian Mulberry, great to have you. Merry Christmas. Senior Client Portfolio Manager at Zacks Investment Management, kicking us off to the close here on this Tuesday afternoon. When we come back, I'll push ahead to what markets can expect when it comes to real estate, and more importantly, on the issue of affordability. It's become a hot button issue. A conversation up ahead with Meredith, Whitney, when we come back after the break.
And from affordability to luxury, we'll take a look at the lucrative fashion resale world. Ben Hemminger, he is CEO and co-founder of Fashionphile, joins us to discuss why investing in a Chanel might bring better returns than investing in equities.
And the only thing that could potentially bring better returns, and that is, how about a Pikachu card?
Oh.
Conversation up ahead about the world of collectibles with Logan Paul, of course, a famous YouTube influencer, and Ken Goldin, legend in the collectibles space. You got to see what he was wearing.
I'm excited.
Millions of dollars around the neck. All that more coming up in a bit, right here on The Close on Bloomberg.
Novo Nordisk shares soaring today with the drug maker winning approval for a first-of-its-kind GLP-1 pill. I got the chance to catch up with Novo Nordisk President and CEO Mike Doustdar on the heels of the announcement about how the Wegovy pill could shake up this very competitive space. Here's part of that conversation.
This is really going to be super exciting for the millions of patients that have been waiting to get their hands on a GLP-1 pill. And for the first time, we are having a pill that has an efficacy of some 17% if you take the pill regularly, and 1 in 3 people are going to actually reduce up to 20% weight loss. I think that data speaks for itself, and we are super excited, of course, to be the first to the market, and we're going to go all in trying to make this a huge success.
Well, moving forward, I mean, beyond just these first few months, after Eli Lilly does have their pill on the market, how do you plan to compete? What is your strategy there, given my understanding is that there's likely going to be no restrictions when it comes to food, when it comes to drinks, around Lilly's version?
Yeah, so as I mentioned, there are no other phase 3 trials of oral GLP-1 that has shown this level of efficacy. This means that for the first time ever, people do not have compromise between either taking an efficacious injection or a convenient pill. For the first time ever, you have the same efficacy of 17% in injection or a pill. You can take it on a daily basis as a pill or a weekly injection. And that, I think, is the key selling points with Wegovy pill. We also have more than 10 years of course, experience with regards to safety data and what have you. That's why it's called the Wegovy pill, which means that this pill is not only going to reduce your weight, it also has protection for your cardiovascular systems. So this is a phenomenal pill, second to none, I would say, and we are very ready to compete with it.
Let's talk about how you're going to sell it. Through what channels will you sell this Wegovy pill, and will all of those channels be available at launch?
The quick answer is yes. We're going all in. We're, of course, going to sell this through our own websites, NovoCare Pharmacy, as well as all of our partners, be it Ro, LifeMD, Costco, Weight Watchers. Everyone that you can imagine is going to start launching this at the same time on the day of the launch. Trump RX, of course, will be coming up soon as well as, of course, the traditional channels that usually medicine is procured in U.S.
Well, to that point that, it's going to be widely available, let's talk about supply. I know that you've already started production. How confident are you that you're going to be able to, meet all of that demand at launch, given, of course, the supply challenges that you've been through in the past?
Let me take you back. 10 years ago, when we started the journey of putting a peptide into a pill, no one thought scientifically that is possible. You have to remind your audience that pills are usually chemical entities, small molecules, and not proteins and peptides. And often they have lower efficacy because of that. When we decided to actually go this route, everyone thought scientifically this is impossible. Then after that, when we proved them wrong, people thought that we cannot scale that because this is quite difficult to do, again, because it's large molecule inside a pill. Again, we have shown confidence that we are able to scale this more than enough for every single person who would want to take the pill, and we're ready for that. And then, of course, lastly, people are writing us off that, this would not be possible at an affordable price. And I'm also very happy to say, once again, we are proving all of these skeptics wrong. So I'm super excited that we have something that is borderline miracle, in my own humble opinion, a peptide in a pill with a high efficacy, produced at scale, and we're going to actually sell it through all channels at relatively affordable price.
And our thanks to Novo Nordisk President and CEO Mike Doustdar. It was a really interesting conversation Romaine. It didn't make it into that clip that we showed, but I also asked him about M&A. You remember that high-profile bidding war that they had with Pfizer for Metsera. Pfizer ultimately won out, but he said that they're absolutely looking at more M&A, so definitely a name to watch in 2026.
Absolutely. A great interview, and also gets to this idea of just how they kind of broaden out their portfolio. I mean, obviously, having a pill helps differentiate them, but at some point you also wonder sort of what's the next step. You don't want to sort of become, the next Moderna or, kind of a one-trick pony, if you will.
Right, absolutely. You want to diversify that portfolio. This is a big moment for them, though. We know that they've lost a lot of U.S. market share to Eli Lilly. The fact that they have at least a couple months where they'll be the only game in town when it comes to oral pills in the U.S. market, it's a pretty interesting sort of turn here when it comes to the race between these two. But you take a look at the shares year to date. Novo down 45%, Eli Lilly up 40%. There's a clear winner when it comes to the stock market.
Yeah, absolutely. A great conversation that you had early in the morning, Katie Graffeo. When we come back here on the close, we're going to stay in the tech space here. A conversation with Brent Thill over at Jefferies. We're going to get his insights on the trends that could shape the direction for hyperscaler stocks in 2026. That's coming up next here on the close. This is Bloomberg. All right, time now for our top calls, the big movers on the back of analyst recommendations. We're going to start today with Levi Strauss. Raymond James initiating coverage of the jeans maker with Outperform and expectations for the shares to rally more than 20% from current levels to $26 over the next 12 months. The price target implying mid-single-digit revenue growth and high single-digit earnings growth, fueled by broad-based business and expanding EBIT margins. Those shares, nevertheless, down about 0.8% here on the day. Next up, let's take a look at Coty. Evercore ISI cutting the beauty company to in line as Coty's CEO stepping down. The analyst saying much of his investment thesis rested on the CEO's vision, and without her there, the lack of visibility on potential upside catalysts means the analyst, for at least right now, is throwing in the towel. Those shares down a second straight day as that stock heads towards its worst annual performance since 2018. And finally, let's take a look at Tesla. Canaccord boosting its $482 price target to $551. That's the second highest on the street. The firm flagging, quote, constructive developments beneath the surface and encouraging investors to look through any softness for the quarter. Those are some of our top calls. Meanwhile, we want to push ahead, well, to not only the next quarter, but the next year. We're keeping an eye on hyperscalers, another group fueled by long-term bull cases tied to the AI build-out. A new analysis from Bloomberg Intelligence expects generative AI to reach $1.8 trillion in revenue by 2032. Joining us right now to talk about his outlook for hyperscalers in 2026 is Brent Thill, tech sector leader at Jefferies with a focus on software and internet research. Brent, it's been a great year for pretty much all of these companies, most of them, we should say, in this space here. How, if at all, does it get any better in 2026?
Yeah, I mean, it's been a great year. As you mentioned, I think ultimately there's a high degree of skepticism right now, and will AI pay off? And so I think we're entering 2026 with some degree of skepticism. Some of these stocks have sold off on that concern. And so I think we got to get better referenceability, more AI revenue data points. As you mentioned, most of these stocks have done pretty well. Amazon has lagged materially, so we think that's an interesting name where we think backlog and growth rates can accelerate. So Amazon would be a name on this weakness that we like on the pullback. But I think, it comes back to real mile markers now getting live referenceable customers up and going. And everyone's talking a big game, but can they deliver? And as they say in West Texas, big hat, let's see the cattle. And we haven't seen the cattle yet on some of the revenue numbers, and at least in the application sector. We've seen acceleration at Microsoft. We've seen acceleration at Google. We haven't seen that yet at Amazon. We think we're going to see that, so we think that'll kick in. Again, should be good for many of the players, but it should be, in our opinion, really good for Amazon as they've been playing catch up.
When you look at the landscape of these companies, I am curious as to what your thoughts are specifically on Meta, particularly when it comes to the AI story, because it seems like they are the outlier, or at least investors are treating them like they are the outlier relative to some of the other names that you just mentioned, Brent.
Yeah, I mean, actually, Meta's outperforming even Amazon, so I go back to Amazon's been treated as the biggest outlier. But to your point, yeah, on consumer, I would agree with that. So we look at it, enterprise versus consumer. It's really Google versus Meta. Google's up 66% year to date. Meta's up about 14. And I think there are some concerns about what Zuckerberg has said in terms of the next level of investment that he needs to make. We would buy into that fear because they've always proven that they actually show an ROI. And I think when you look at it just as a consumer of Instagram, they know what I like. They nail it, and within 10 seconds, I have all the right ads in front of me. So I think in terms of consumer AI, they're in a great spot. I think the hidden thing on Meta, I think they're going to start to sell their infrastructure to enterprises. And they have today a really good back end that they run, similar to what Amazon ran on AWS. Why is Meta not renting this service out to enterprises? And I think there's a hidden call option where they could do that. I have no idea when they're going to do it or how they're going to price it, but I think everyone we talk to is like, this is a big opportunity for them to get more into enterprise on that side. And I think from the consumer perspective, there's no other consumer play that can monetize like Meta on AI. You can just see it already in the platform. You can see what they're doing. You can see it with wearables. There's a pretty rich ecosystem they're building. And the advertisers agree with what we're saying, and that's why we're so bullish about what Meta's doing.
Well, Brent, let's say that were to happen, that Meta did actually, start selling to enterprise. Who would they be competing against there, and how stiff is that competition?
Yeah, it's Amazon, Google, Microsoft. I mean, it's stiff, but if you think about, they run one of the top open source products that companies are using. Jefferies is an example. My firm is using this technology, and our CIO said, "Look, if they would sell this to us as a packaged service, we would be a buyer of it." They don't do that today. And so I sit here and look at what's the call option, what's the upside. And it seems like there's a great opportunity because this is exactly how Amazon started with AWS, right? They had their own internal service that ran their own e-commerce site. They're like, why don't we sell this to the rest of the world?
Right.
And look, it's the biggest profit driver, and it's one of the biggest portions of their market cap. So I think, again, I don't know when they're going to do it, how they're going to do it, how they're going to price it. We're just saying we think there's a call option for them to do more than just consumer.
All right, Brent. We'll see if anyone from Meta is listening right now. Really appreciate your time. That is Brent Thill of Jefferies. Coming up, we'll be speaking with Meredith Whitney. Don't go anywhere. This is The Close.
.30 p.m. here in New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We are counting down to the close on, it's Tuesday, right?
It is Tuesday.
It is
Katie,
Tuesday.
Right? It's the eve of Christmas Eve.
That's true. Christmas Eve. We're keeping an eye on these markets, also keeping an eye on the housing market. Of course, it's something we've been talking about all year. And there's.
Are you getting me a house for Christmas?
No, absolutely not.
I would have been indebted to you forever.
That's truly the case. Mortgage rates actually are in the low 6% range. This isn't something we've seen in a while, but then you take a look at homebuyer sentiment right now, and it remains pretty depressed. And 6%, I mean, where we are right now, maybe it's the most affordable sort of levels that we've seen in almost 3 years, but still, compared to, history beyond that, really high levels.
Yeah, absolutely.
Well, let's keep this conversation going with Meredith Whitney. She is CEO and founder of Meredith Whitney Advisory Group. Meredith, great to have you with us. Let's talk about housing. Let's talk about affordability, because I'm taking a look at your notes, and basically you say that rates alone are not the problem. Give us the other piece of the picture here.
Yeah, I think that most people look at rates and wonder why the housing market's not picking up, astonishingly. And the big issue is that home prices are up nearly 46% from 2020. So it's the affordability is about rates, but so much more about the price of a home. So it's prohibitive for new home buyers to get into the market, and even some existing home buyers to relocate within the market. And there's a couple other things that there's one main thing that also is keeping the market gummed up, which is 60% of the existing homes are owned by people over 60. So it's really like the market's really gummed up. They don't want to sell, and so your 2025 will be remembered as the slowest existing home sales market in over 25 years. And I don't see that improving dramatically anytime soon, whether the Fed cuts rates, 100 basis points or not next year and the following year. I don't think the existing home sales market is going to move very much.
Right. Yeah. And you think about, what the Fed is expected to do next year, certainly not even 100 basis points of cuts. But it's interesting. You have this sort of equation in your notes. You write that rates they need to decline by at least 200 basis points and home prices need to decline by at least 10% in order to revive home sales. That's not an either or. That is an and situation. Meredith, is that a scenario that we could actually see play out?
No, I don't think it is. And here's the critical factor. The existing home sale market, I don't think is going to, whether rates go down, I don't think home prices are going to go down enough to make existing homes affordable. However, next year, the main thing of investors' focus should be the fact that it's a midterm election year and all eyes are going to be on affordability. Now, many things like food prices, services costs are going to be really sticky to come down, right? They're the actual inflation rate may slow, but the impact of cumulative inflation is very real, and investors or shoppers are feeling it in their wallets. But two things are coming out, or three things are going to come out. So in July, the Senate Banking Committee passed on a bipartisan basis the ROAD Act, the Road to Affordability, reinventing the Affordable American Dream Act. And then last week, the House Banking Committee passed the Housing for the 21st Century. Now, at a very high level, these bills are very similar, both resounding bipartisan support and both dealing with what legislative issues can be done. Now, most of what's going on with real estate is being done, needs to be done at the local level, and I'll get into that in a second. But what these two bills are focusing on is new home creation and new manufactured home creation, which is less than a quarter of what site-built construction is. So manufactured housing are going to be the critical focus for track for politicians as well as investors.
But Meredith, I am curious though. I mean, can you go to the local level for a second too? Because I mean, there's also a big issue with regards to land use being a factor in addressing affordability. This is something that the incoming mayor of New York City has pointed out. A couple of governors over out west have also stated this as well. Do you think we might see more progress coming from the state and local level in addressing this rather than at the congressional federal level?
Romaine, you're so smart. I'm so glad you brought that up. Thank you. So the one thing that has been floated is the use of federal land, but federal land is not going to be attractive for many people who want to be home buyers, right? It's too remote, it's too rural, but states are huge owners of assets, and states can free up either municipal land, and that's going to be under the governor's control. So there's a legislative approach, and then there's going to be an executive order approach. So I think this is something that Trump is really going to dig into, which is coercing the governors to really be proactive at the going down the food chain at the local municipal level and giving up state and municipal land to enable home site production, and particularly.
I think we're having some technical difficulties with Meredith's connection there. Meredith Whitney, the CEO and founder of Meredith Whitney Advisory Group, and of course, prior to starting her own macro firm, a strategy firm, of course, a legend on Wall Street, who had some very prescient calls about the banking crisis way back in the days. And it gets, sorry, Meredith, I think we still have you. If we can bring you back into the conversation. I do just want to get your thoughts real quickly, Meredith, on just the issue of the perceptions of affordability, because it's one thing to talk about the reality of it, but we know that inflation, or at least the perception of inflation, often is just that, perception. And there are a lot of people, particularly in the middle income spectrum, who they look at the price of things, whether it's homes or even something more pedestrian like groceries, then they look at their own wage growth and they don't see it keeping pace. And I do wonder how much of a psychological effect that has on some of the issues we've had when it comes to housing and housing affordability.
Well, you bring up another great point. I'll tell you that home equity usage is being used more now for cash management and making ends meet than it has ever been used before in history. So home equity is growing faster than any other consumer loan category. And historically, home equity has been used for home renovations. But as Home Depot said, home renovations are not picking up to their expectations, and they guided down because of it. More and more people are using, actually, there's been a very sharp increase in people using home equity withdrawals just to make ends meet. I think that number is going to be closer to 50% when 2025 is tallied, and that tells you that consumers are really strain. Now, home equity is going to be the cheapest source of debt, but it's also not something that everybody wants to tap into. The fact that so many people are relying on that to make ends meet tells you it's more than perception. It's a real reality that people are very stretched financially.
All right, Meredith, I have to leave it there. Always wonderful to catch up with you. Have a wonderful holiday if we don't see you before then. Meredith Whitney, CEO and founder of Meredith Whitney Advisory Group. When we come back, everyone's wishing for silver and gold this holiday season, especially with the recent rally. We're going to take a look at some of the stocks, and the miners specifically, that have moved the most on the back of this monster rally in precious metals. That's our Stock of the Hour, and it's up next. This is Bloomberg. Time now for our Stock of the Hour. Keeping an eye on shares of Freeport-McMoRan. Right now headed towards their best annual gain since 2010. The mega mining company getting swept up in the metals rally that's pushed gold, pushed silver, and copper to fresh record highs. Joining us right now is Norah, Mulinda, Bloomberg's market correspondent, to talk a little bit more about this move higher. We should point out, this has been a phenomenal run. Obviously, what we've seen in gold this year, silver, of course, copper topping $12,000 yesterday briefly. What's actually driving this? Is there some real fundamental reason why we're seeing this so high?
So it's a bit mixed because you pointed to gold and silver. We know that those tend to be defensive plays when we think about people hedging against inflation. Also, you have the central banks that are continuing to buy gold. You've got geopolitical risk. So when you think about gold and silver, that's what that tends to be linked to. But copper is a bit more cyclical. So you're also seeing a bet on growth, because if you think about the fact of like electrification, for instance, you do need copper for EVs, for data centers, for renewable energy. Think about the power grids and whatnot. So it seems like
aren't these in conflict with each other?
See,
I mean, if you're betting on growth by buying copper, and then you're betting on what, I guess, some sort of turmoil by buying gold, somebody's wrong.
I guess somebody's wrong. But clearly, if you look at stocks, we're looking at Freeport-McMoRan. We're seeing shares higher. You're definitely seeing a rally there. And that's essentially a fusion. This is one of the few companies that gives you exposure to both gold and copper at the same time. So we've seen a very strong rally from this stock in particular.
That's like the reverse Uno card there.
Right?
Yeah.
They're playing
my
both
favorite card.
sides, so they're having fun. It is interesting if you take a look at gold miners overall, though. I like to look at everything through ETFs. The VanEck Gold Miners ETF, the ticker there is GDX. You compare that to GLD, which is just the State Street Gold ETF. You can see that GDX, which is the gold miners in gold, which is cute, is higher by about 167% on a year-to-date total return basis. You compare that to GLD, up a pedestrian 69% or so.
Very pedestrian.
I don't necessarily expect you to have the answer, but it is interesting to see the gold miners, the gold equities outperform the actual metal itself this year.
No, it's really interesting seeing that. That did come up in my reporting, but I couldn't really narrow down the link as to why we're seeing that difference there. But it is interesting to note in terms of copper being cyclical. We've been talking about copper a bit. Supply is also constrained when we think about developing these new mines and how it takes years to develop. So you are seeing a lot of investors that are also just putting their money toward the idea of the future and thinking of this as a key beneficiary when you think about Freeport-McMoRan and just the broader space, thinking about that as a beneficiary in a way to sort of do that AI play, but from another angle.
Do you know what McMoRan stands for?
Tell
I was
me.
just looking this up. It's the combination of three of the founders' names.
Oh, that's cute.
William Kenna McWilliams, it was the Mac, James Robert, Jim Bob Moffitt, who was the Mo.
Oh. Okay.
And Mac Rankin, who was the Ran. You didn't need to know this, but this is what I do.
now we know.
When you're answering questions, I'm just going down the Wikipedia rabbit hole here. But it does get to this idea also, the idea of whether this continues. When you have these types of phenomenal run-ups, everyone starts to wonder whether you're going to get this reversion to the mean. Is there something that keeps us going?
I mean, that's what we're looking to hear from a lot of analysts. I mean, we did hear from Scotiabank. We also heard from Jefferies. Analysts over there are still
Jefferies,
saying, you like that company?
Yeah.
They're great. So they do expect copper mining stocks to continue to see growth in 2026. So it does seem to be a bit of a bullish call here when we think about the sector in particular and the run continuing.
Pop quiz for you.
Yeah,
Do you know what
please.
CVS stands for?
You know?
Oh, I should know this.
I should
I found this out inadvertently.
Please tell me.
Actually, I was watching a stand-up comedy special at Consumer Value Stores. That's what it was called way back in the day.
That's
And then
interesting.
at some point, somebody realized let's just shorten to something hipper.
I can remember this for a trivia night.
Yeah.
My favorite is IBM, International Business Machines. It's just so quaint in the year of our Lord 2025.
I'm glad they're international, though.
Yeah, definitely.
If they were
Could
just
be
U.S.
domestic.
business
The
machines.
machines are for business, which is great. Norah, Mulinda, that is our Bloomberg
We're
Markets
easing into the weekend here.
correspondent. Coming up, Steve Quirk from Robinhood Markets joins us. This is The Close.
Just about 10 minutes until we get to those closing bells. Romaine Bostic here alongside Katie Greifeld. A full trading day today, an abbreviated one tomorrow, and of course Thursday, a national holiday here before the Christmas observance.
Well, we are rallying into it. The S&P 500 up for a fourth straight day, looking at record highs for the close for the S&P 500. I will say the trading volume less than inspiring right now. It looks like versus the 30-day average trading volume is 31% lower. So not a lot of conviction necessarily behind these moves, but you can see big tech rallying, as too is gold. The bond market not really doing too much today, Romaine. Pretty much flat when it comes to your 10-year Treasury yield.
And we talk about that drop in volume. Always a reminder to take the price action this time of year with a bit of a grain of salt. We may not get a real read here on what exactly that conviction is amongst investors until we get back into January. But we're kind of trying to divine exactly where it stands at the moment. And we're going to do that with Steve Quirk. He's the Chief Brokerage Officer over at Robinhood Markets. Steve, always great to talk to you here. We just kind of want to get a read here. I mean, heading into the end of this year, when we talk about the level of activity, not just on your platform, but the actual engagement itself here, what did that look like? And did it surprise you based on what you know?
If you're referencing the year in general, I would argue it's been a customer from a retail standpoint very engaged across virtually every asset class, and we've seen that across both our volumes in terms of equities, options, crypto, even on the prediction market side, and then deposits. But coming into the end of the year, I think we've seen strength in terms of engagement and people sort of finishing out the year. I think there was a little bit of a concern, in the first part of December when we had a stretch of down days if we'd ever get this Santa Claus rally, but it seems to have materialized, and we're seeing that sort of finish off today here.
Yeah. Well, what do you see in terms of what people are buying? Is there this sense here that given the huge run-up that we've seen in tech stocks this year, that we'll see some of that sold profits being taken? Or do you think people are going to basically ride this even longer, maybe even double down on some of those bets?
What we've seen, Romaine, is it's kind of a rotation. So what you'll see is as those appreciate and they have spells, like after the tariffs, they had a pretty big downdraft and then a nice run up, and our customers stepped in, bought them, and then sort of rotated out into names that had not seen the appreciation that those had. More recently, we've actually seen people re-engaging in the same names that are the most popular names, the 7 or 8 names that kind of dominate the tape. So I think there's a belief that there's still some more room to run if I'm looking at the customer behaviors.
It's interesting to hear that re-engagement in some of those names. Are there any areas of the market where there is just non-interest, no demand to speak of when it comes to the average Robinhood customer?
No, and actually I would tell you it's kind of surprising when you think of the average age of our customers. Early 30s, and many of them are first-time investors. You would think some of the names that do populate our top 10 or top 25 wouldn't be in there, like Ford, or I heard you speaking about IBM or others. Surprisingly, our customers like dividends, and so they tended to get in some that some might consider sort of stodgier stocks. They like to mix those in with some of the ones that move a little more aggressively.
That's interesting. Millennials, have a soft spot for international business machines. Definitely a fun fact. Let's talk a little bit about prediction markets, though, because I'm taking a look at some of the metrics you sent over to us. And when it comes to event contracts, obviously, you're seeing a lot of growth there. How does that sort of factor into what you're seeing when it comes to trading traditional equities? Because there is that school of thought out there that what we're seeing in prediction markets, event contracts, how much fun people have trading those, that perhaps you could see some of that activity shift from the traditional equity markets just to the prediction markets.
Yeah, I think we haven't really seen that, because I would also remember we're a scale player on the equity side and traditional brokerage, but we're a scale player on crypto as well. So when you add in the prediction markets, I think what we've seen is within our customer segment, there's separate segments that are interested in a variety of the different pillars of those event contracts. So in other words, there's a demographic of people that are very interested in the elections and that participate in things around elections. There's a segment of customers that are very interested in the economics. Will the Fed raise rates, CPI, PPI, et cetera, et cetera. There's a segment of customers that are very interested in cultural. And then there's a segment of customers that are very interested in sports. And they're not always the same people. And we tend to see them using these in addition to all the other things that we offer within the Robinhood ecosystem.
So give me a sense here then, Steve, and when we start to talk about next year and some of the big themes that drove this year, where do you see potentially it broadening out? I don't mean in terms of what people are picking, but whether that the themes are going to be materially different in 2026.
If I think about the themes that I think, and some of them are a continuation, I think AI is going to continue to be a theme, both from an investable asset standpoint, but also from the capabilities that we've been rolling out and helping deliver for our customers to be able to better navigate or find opportunities within the market, or even understand why the market's moving. So I think that theme will continue, because I think there's so much more room to run there. I think the event contracts will continue to, we'll continue to see other areas where these are going to have a lot of utility for people, not just from investing or hedging, but also from a source of information so that they can make better investment decisions elsewhere. And then I think in addition to that, I think we're just going to continue to see this strong engagement, because of this retail engagement. We continue to see percentage of activity and equities and options and margin continue to go up, even in IPOs, that is retail. And so I think we're going to continue to see retail be a stronger force across the board in the industry, which I think is an excellent thing. And, I think we all kind of really love to see.
Well, talk to us about retail involvement in IPOs. That's certainly a trend that we've seen really just gain ground in the last couple of years. It seems like 2026, it's expected to gain more momentum. How does Robinhood sort of seize on that opportunity? Because you think about some of the names in the private market that could be coming public, a lot of excitement there, Steve.
I think I love what's happening in this space. And we have a product called IPO Access where we get an allocation. If I go back 5-6 years ago, we had a scratch and claw to get an allocation of 1 or 2% to retail. Most of it went to institutions and wealthy individuals. And now that script has been flipped in some instances. We're getting, in one case, we got 20% allocation from a firm that came. And so I think companies are starting to understand the importance and the force that is retail. And as a result, we're starting to get larger allocations for those retail customers. And by the way, those retail customers, I think 2/3 of them, if you look out 2 to 3 months after the IPO, they're still holding them. So they're not just taking that and flipping it. They're actually passionate fans of these companies who are true believers, and that's who you want as shareholders.
Steve, always a pleasure. Have a wonderful rest of the year. We'll catch up with you in 2026. Steve Quirk, Chief Brokerage Officer over at Robinhood Markets, helping us count you down to the closing bells. Katie Greifeld here on this Tuesday afternoon. A mixed bag with the Dow, the S&P, and the NASDAQ in the green, but the Russells, the mid-caps, the transports, all the economically sensitive type of sectors in the red.
Yeah, and it's interesting to see that because it's not like you're seeing a lot of direction either way in the bond market, specifically when it comes to the Russell 2000. That tends to be a guiding light, but still, it's hard to complain when you do have the S&P 500 at record highs and a fourth straight day of gains, though, on very uninspired volume.
Yeah, down pretty dramatically here. Let's bring into the conversation Norah, Mulinda, our Bloomberg Markets correspondent, and Emily Graffeo, who helps to lead our markets coverage here at Bloomberg. And Emily, I'll start with you here. I mean, the grain of salt, obviously. Volumes down, holiday trading week, can't read too much into the price action. But when you look at the momentum into the end of the year, is that a potential positive when we come back in January in 2026?
Yeah, I mean, I saw a note earlier today that said that there's really no reason to sell right now, particularly when you look at the economic data that we got today. Even though it was a backward-looking GDP number, it was really good. It beat pretty much every expectation. That's kind of serving as that momentum for the rally to continue.
Did that economic data at all, to you, Norah, presage some sort of real movement in this market?
I mean, it's interesting as we're seeing these double-digit returns on the year. What I'm looking forward to is the Santa Claus rally that we're always looking out for at the end of the year, which we know kicks off on Wednesday. So tomorrow we'll have our eyes on that as to see how the S&P 500 fares as we head into year end.
Yeah, a great reminder here. That rally traditionally will kick off tomorrow, but we're actually getting a taste of that today. In fact, over the last 4 days, 4 straight days of gains for the S&P 500, 6909.73. That's a record high, folks, up 31 points on the day, or about a half a percentage point. The Dow Jones Industrial Average adding about 79 points, or 0.2%. The NASDAQ Composite up about 0.6%, half a percent gain for the NASDAQ 100. But as we were pointing out, when you take a look at the S&P 400 mid-caps, Dow Transports, and of course the Russell 2000, all moving lower here on this Tuesday afternoon.
And an interesting bit of texture is that when it comes to sort of the breadth here, it doesn't actually look that great when it comes to this rally. If we take a look at the sectors, as measured by the circle, you do have more gainers than losers when it comes to the sectors. It's a different story when it comes to the individual names. But all that really matters is that you have that big green bright spot when it comes to tech. That was, of course, your biggest points contributor. Communication services also did well on the day. So, too, did energy. In terms of what didn't perform exactly for the second straight day, at least, it was consumer staples bringing up the rear. Healthcare also not faring too well. Eli Lilly did take a little bit of a downdraft, and industrials as well.
About 286 stocks in the S&P 500 to the downside today. That matches up with 216 to the upside. The net effect of it, though, was the S&P to the upside. Norah, what drove those gains today?
Well, healthcare, while it wasn't one of the outperformers in the S&P 500, we did see some strength from Novo Nordisk. We saw shares ending up about 7.3%. This is after the company won approval for the pill version of its obesity shot Wegovy in the United States. It'll start selling this oral drug in early January. And of course, this kind of puts it at a jump start ahead of its peer Eli Lilly, which has its own oral obesity drug pill to be coming out and being approved early March is the expectation there. So you are seeing investors clearly celebrating this win for Novo Nordisk, but shares on a year-to-date basis for that stock down more than 40%.
Is this pill, Katie Greifeld, because you had a chance to interview the CEO, is this pill going to be as effective as the shot?
It's comparable. I think what is really the differentiator here, though, is the fact that it's a pill. You don't have to inject yourself. You do have to take it daily. But for a lot of folks, a daily pill looks a lot better than a weekly injectable. I did ask the CEO, though, does this expand the total addressable market, or does this just cannibalize sort of what you're serving when it comes to the shots? And it's unclear at this point, but it's going to be fascinating to see.
Yeah, absolutely.
At least you don't have to refrigerate it, I guess, right?
That's true. It's also easier to store.
Yeah, the way that you have to refrigerate the shots.
Yeah.
Oh.
Yeah.
The more you know.
Oh, you learn something new every day. What else you got, Norah?
Looking at shares of Zim Integrated, this is a $2.5 billion market cap shipping services company. We did see that the company is evaluating proposals from multiple potential buyers. The review of strategic alternatives is in quote-unquote advanced stages, the company is saying. So we are seeing shares of the company ending about 5.8 8% higher. And lastly, I wanted to look at the psychedelic space.
What?
We're actually seeing a New York City-based psychedelic drug developer. Yes, you heard that right. The stock is called Minds Med. We're seeing shares up about 5.4%. We had some analysts over at Jones Trading initiating coverage with a buy rating on this stock. They're saying that the buy rating and the price target that they place on the stock implies that it can jump more than 350% from its last close. Of course, this is about a $1.3 billion market cap company, but they're saying that it's well positioned to benefit from the trends that are favoring the psychedelic agents in the psychiatric space. So we'll have to see.
Yeah, or not. Emily, what do you got here? Get high on life, Emily.
Hey, I don't have anything as fun as a psychedelic company, but I'll start with a software company, ServiceNow.
That's exciting.
Stock was, yeah, you know, for some people, the stock was lower, down about 1.5% to close the day. They reached a deal to buy the cybersecurity startup Armis in a deal valued at about $7.75 billion. It's the company's largest acquisition to date, and they're going to be funding this transaction with cash on hand and debt. Apparently, the equity investors didn't like that news that much. The stock, though, is up 40% year to date. A stock that's not doing that well year to date, though, is Coty. That stock.
We should point out, too, we're going to actually have a conversation in just a few minutes with the COO, the president, COO, and chief product officer over at ServiceNow about that deal.
Okay, so watching that. Stay tuned, everyone.
Yeah, don't leave.
I'll be tuning in as well. Just back to the decliners here, two more. Coty, Evercore cut its recommendation to inline on this stock. Following the exit of its CEO, analysts said that CEO, Sue Nabi, has been central to Coty's investment thesis. So we saw that stock down about 4%, and it's down over 60% year to date. This is a makeup, beauty, perfume company. And then finally, Coinbase fell about 2% today. It was higher yesterday, so maybe investors taking some profits here. They announced just yesterday that they're going to be acquiring a derivatives clearinghouse, the clearing company, to boost entry into prediction markets. Of course, Coinbase, one of the largest cryptocurrency exchanges. We saw Bitcoin lower today at about 88,000. Whenever Bitcoin's in the red, we typically see the exchanges like Coinbase in the red as well.
Absolutely. Let's take a quick look at yields here. A mixed bag there, similar to what we saw in the equity market with the short end of the curve. You're seeing yields higher, only by about 2 basis points on your 2-year, your 5-year, your 10-year yield, up basically unchanged on the day. We should point out the long end of the curve, which we don't have there, actually moving lower on the day. Your 30-year yield down about a basis point, right around 4.823.
So pretty quiet when it comes to the bond market, probably because everyone is already traveling. A really interesting story on the terminal today, talking about how airlines are anticipating record volumes. According to the Airlines for America lobby group, a daily average of 2.9 million passengers will travel between December 19th and January 5th. That is 1.5% more than a year ago. And get this, domestic airfares over that period will average $900 for a round trip. That is 7% more than last year. That is according to the American Automobile Association. So a lot of people are traveling, and they're spending a lot of money to do it.
What I love about the story is they point out that a lot of the major airports right now are actually going through major construction activity, including here in New York. And if anyone's been to JFK lately, God bless you, Chicago and others. So it kind of creates also potential room for hiccups. Now, I'm curious, because I know at least 3 of the people on this panel aren't actually flying this holiday season. What about you, Emily?
I'm not flying.
So none of us really have any real skin in the...
Oh, you are.
Sorry.
Tell us.
I know. I skipped the train. Decided to hop on a plane.
Okay. All right. Well, and you think that's going to be better?
Fingers crossed. We surely hope so.
You might get lucky.
But it gets to the idea, too, we talk about this holiday season and the importance for the economy. I mean, we talk about it molded from Black Friday shopping, but it's also, of course, the amount of money people spend on travel and all the things that go into that.
Yeah, I mean, the record numbers, I actually have a running joke with my cross-asset colleague, Denitsa Sakova, that every holiday season, it seems like we get a headline about record traffic, record foot traffic at airlines, and I sent her this story earlier today and said, like clockwork, we're having record volumes again. It's like, are more people every year going to the airport? Is that what it is?
Apparently so.
I don't know how that works. I mean, doesn't the population go up every year?
But it does feel like it says
I want the per capita number.
Every year.
Yeah. Well, it's like the stock market, the number only goes up. It'll be interesting to see how the airlines actually handle this increased volume. Romaine, I feel like I've been watching you on holiday specials where certain airlines are like dealing with horrible snafus.
Yeah.
So it is a very important proving period for these airlines as well.
Yeah. Do they care though? I mean, because I feel like, they know they're going to make money either way. And it gets to this idea, too, that this isn't just on the airlines. Obviously, we kind of forget about all the air traffic control issues we had a couple months ago, but also a lot of other issues on the regulatory front and obviously what went on at Newark Airport in New Jersey here. So we can't put it all on the airlines, though I put most of it on them.
That's a fair point.
Yeah.
If the airlines are watching right now.
All right. Well, I don't know what you three are doing for the rest of the week. This is my last day.
I know. I know.
So,
Norah
but I'm
and
not
I are
flying.
actually going to be at this desk tomorrow, and I'm sure
will.
Emily will be here as well in the morning. So
All right.
Tune in.
I will be.
I will TiVo that and watch it at some point
TiVo.
in the
Last minute
long-term
pass.
future. I know. I was going to say, what was the old thing?
I don't know, DirecTV.
Norah Mulinda, Bloomberg's market correspondent, Emily Graffeo. Our thanks to them here as we wrap up our coverage here of the closing bells. But our coverage here on the close continues on. We're going to have a broader discussion up ahead about alternative assets, but we're going to talk about it, not talking about PE funds or real estate. We're actually going to talk about it from the perspective of collectibles. A conversation up ahead with Logan Paul, the entertainer and entrepreneur, and Ken Goldin, of course, the legendary collectibles CEO. That's coming up in just a bit, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic here on this Tuesday afternoon. A record-setting day, believe it or not, for U.S. stocks, despite the, lack of volume in the market. But you know what? Sometimes you don't look a gift horse in its mouth. A 0.5% gain on the S&P 500 today, 69.09. We'll just round up to 69.10. That's good enough for a record high. And it's an interesting sort of bookend to this year. We still have a few trading days left, but the idea here that some of that enthusiasm that we saw come back into this market that started the year, come back into this market in April and in May, finally sort of getting its mojo back here in the final few trading days of the year. You did not necessarily see that with some of the more cyclical sectors, particularly as reflected by the small cap Russell 2000. And you're still seeing a bit of a bid into safe havens, including gold and silver, another record high for spot silver.
Well, let's take a look at some of the equity movers today. Up at the top, you have NVIDIA. One of the big reasons why we were able to hit that record high was the fact that NVIDIA shares higher by about 3%. A different story when it comes to Moderna. You can see that those shares plunged 7.5%. No clear catalyst that I could find, but elevated options volume. And I did want to highlight Eli Lilly. We've been talking about Novo Nordisk getting that U.S. approval for their oral obesity drug. That should launch in January. That puts them ahead of Eli Lilly when it comes to getting that to market. Eli Lilly shares managing to claw back a lot of their losses, but finishing down about 0.5%. But let's get to our top story this hour, and that is that the U.S. economy is growing and fast. According to the latest GDP print, the economy grew at its fastest pace in 2 years during the third quarter, bolstered by resilient consumer and business spending and calmer trade policies. And that was despite the shutdown weighing on fourth quarter growth, and economists are still expecting a modest rebound into the new year. Now, Atsi Sheth, she is Chief Credit Officer over at Moody's Investor Service, says that the big question now is how resilient growth remains and if tech spending and higher income remain, whether that consumption is buoying that growth.
Well, pleased to say that Atsi joins us right now here in studio, too, so we can pose that question to her directly. Great to have you, Atsi. You saw the numbers, and I mean, they were great on the top line. I am curious about two things. First of all, is why do you think we did not see more of a negative impact from some of the tariff turmoil and other policies?
Sure. So the first, to answer your question on the tariff impact, most of the U.S. economy is services, and tariffs are not affecting services. So that's number one. Two, if you recall, we had the tariffs announcement in April. Some of those tariffs were rolled back. Some of them were still being negotiated in the third quarter. So that's the second part of the equation, that you don't see that. But then to your headline number question, I do think that 4.3%, very good number. We want to, we want to acknowledge that. But if you think about year-over-year growth, The first 3 quarters of 2025 are about 2% year-over-year growth. So that's still slower than last year.
Okay. It's still slower than last year, but for an economy our size, I think we would normally take that.
Again.
But it gets to this idea, too, also what's driving this. There's been a lot of concern about the idea that the last couple of big GDP reports that we've gotten, there's been an outsized contribution coming from the CapEx spend, which we presume is primarily tied to the AI boom.
Absolutely. It has been, and it continued into this quarter, even though the investment number says it's zero. That's really inventory drawdowns masking the CapEx spend that continues. But the big story, I think, for this third quarter number was the consumer remaining resilient. Yeah. I think, and again, to your point, you have tariffs, you have all this talk about affordability. How is consumption still growing when you saw that in November, unemployment was 4.6%? That's the story, I think.
We'll break it down by sort of income levels, because there is that idea out there about this K-shaped economy where the upper end is doing well. Maybe it looks like a different picture when it comes to maybe the lower end consumer. What are you seeing when you take a look at some of these numbers?
Absolutely that. I'm so glad you asked, because I want to point to 3 things that have been highlighted about what drove consumption per se this last quarter. One was healthcare spending. So if you think about healthcare spending, when you have 10,000 Americans crossing over the age of 65 every single day, you are going to see healthcare spending rise. So some of it is just the aging story. It's not consumer resilience per se. The second, and you were discussing this in your previous segment, is air travel and how much people spent on that. That is a higher income consumer story. So that is the higher income consumer boosting. And the third was electronics, which again, going back to your question, is people buying better devices because now AI can do more with those devices. So it is the higher income consumer driving this.
Well, I am curious to know, you mentioned that when it comes...
Sorry, I looked at you, Katie, because she still has an iPhone 4.
Oh, yeah. So, it's actually over there charging because it doesn't last longer than 30 minutes at a time, so...
Fourth quarter, we're expecting you to buy.
Maybe. We'll see. It's lasted for a while now. It's a kind of a science experiment at this point. But let's talk a little bit about sort of the good side of the economy, because you made the good point that a lot of this economy comes down to services, not necessarily impacted by tariffs. That helps explain why we saw such a strong GDP print. But how is the good side of this economy faring as we do grapple with tariffs?
Yeah, services again, 2 out of the 3 that I mentioned were services sectors, and they are doing great. Technology is becoming a key driver of the good side of the economy, as you put it. And that's a good thing, because it will drive productivity, it will drive investment spending. But there's a flip side to that as well, that now the capital market is becoming very intertwined with the technology sector. So the risk that we see looking into 2026 is the following. We think, again, from a fundamental basis, the tech boom will continue. But if the capital market changes its mind about funding that tech boom, you could see a risk from this good side of the economy.
All right, really interesting conversation, especially as we try to make sense of such a strong print this morning. Atsi Sheth, she is Chief Credit Officer over at Moody's Investor Service. Now, coming up, one of the big deals that we've been talking about, ServiceNow President and COO Amit Zavery joins us on the heels of the company's deal to buy Armis, its largest buyout to date. That conversation coming up next. This is The Close.
All right, ServiceNow, a little bit earlier today, confirmed that it will buy cybersecurity startup Armis. It's a deal valued at roughly about $7.75 billion, and it is ServiceNow's largest acquisition to date. And it introduces a new set of tools the company can use to help its clients defend against cyber attacks. Joining us right now on the heels of that announcement is the President, COO, and Chief Product Officer over at ServiceNow, Amit Zavery. Amit, great to have you here. Talk to me
Thanks for having me, Romain.
Absolutely. Talk to me a little bit about not so much why you needed a cybersecurity company, but why specifically Armis?
Yeah, quite a few things, Romain. So I think if you look at with AI adoption and the volume of devices out there, the AI agents which customers have to deal with, and medical devices, IoT devices, the volume keeps on going up. Customers are finding it very difficult to do security around them and making sure there are no kind of breaches they have to deal with. And Armis is the #1 vendor in that space. They are rated the top, and they have a huge amount of adoption across all the Fortune 500 companies out there. We've been working very closely with them and partnering with them in terms of building out a full security platform. And the joint customers have found our capabilities together very valuable. So when we saw this opportunity and seeing the way that AI adoption is going, this is a great opportunity for us to continue expanding in our security space. So today, our security business has crossed $1 billion at ServiceNow. And addition of Armis will allow us to now get into more new capabilities which customers are demanding from us, as well as allow us to really be differentiated as we add AI, data, workflow, with all of it being around security and making sure there are no breaches customers have to deal with. So that's really the thinking. And Armis is a very innovative company, very well regarded, great team, very good domain expertise. And the combination of us and them can really change the game in the cybersecurity space and build the cybersecurity automation capabilities very fast.
It gets to this idea, too. I mean, you mentioned sort of the potential addition to revenue. I think they talked about a $300 million run rate right now that they're sort of dealing with. This isn't obviously just about the additional revenue that you get specifically from Armis. I assume this is also about bringing in new clients and, more importantly, keeping the clients you have there.
Yeah, this is a very strategic play. I mean, we are very confident about our own revenue plans, right? We don't depend on Armis to deliver our 50-plus, rule of 50-plus, right, which is 20+% subscription revenue growth and 30+% in terms of having free cash flow margin. So we've been 50-plus for the last 10 years, and we keep on delivering that. And we're not dependent on Armis to deliver on what we have been sharing with the street. So this is much more of a strategic play. They are $340 million in revenue already, growing at 50%. But the key thing is the technology and the IP we're bringing in together with ServiceNow capabilities, as well as a lot of the joint customers we can go together with and really provide them a full capability around cybersecurity and help them with all the issues they're dealing with from one platform perspective, right? They have Armis has a lot of data around all the assets company has, the physical assets. If you look at now, physical AI is coming into play as well, robotics and other things like that. That information combined with our ServiceNow's configuration management database, which has assets around software and hardware, we can really give you a full security posture management and really give you the exposure, a guarantee that nothing can go wrong.
And I want to talk about your deal-making posture overall, because we're talking about Armis today, but you rewind the clock to March, you struck an agreement to buy Moveworks for about $2.85 billion. Should we expect to see more M&A from ServiceNow in 2026?
No, I think we have all the assets we require. I think this is an opportunity for ServiceNow to really get into spaces where customers are asking us to get quicker. So roadmap acceleration plus scaled capabilities we require. But I think we are very confident with all the things we have announced so far as the core things we require from our portfolio perspective and acceleration we need to do. We always can continue doing what we've been doing before around tuck-ins and small IP purchases. But from the security perspective, I think we have what we need to become the premium security platform provider in the market today.
And taking a look at some of the sell-side reaction to this deal, both Evercore and our analysts over at Bloomberg Intelligence raised some questions about your organic growth. And I'm wondering, is it feasible for ServiceNow to get back to that, more than 20% organic growth figure?
Yeah, no, Katie, I think that the way we have seen it, and we have been very clear that we are not dependent on Armis, and we will continue delivering the growth we've been delivering for many years. So that one we are very confident about. The foundation is very, very solid. We have to take the foundation and really can continue accelerating beyond what we already do. So our core capabilities around IT and CISO, which is really where a lot of our customers really go to ServiceNow for, we want to make sure that we provide them full capabilities end to end. And deals like Armis allows us to accelerate that. But our core foundation is very strong. We're not dependent on Armis for our revenue plans. And it's very small in terms of revenue perspective from what we're getting from Armis versus what our growth plans are already. And we are very confident of delivering what we have been sharing with the street so far.
Is there an agreement in place right now, Amit, to retain the majority of Armis's employees?
Oh, 100%. So the whole team, we expect to join ServiceNow. Their co-founders, Yevgeny and Nadir, who are very well known in the security space, will join the team at ServiceNow as well. And a lot of everybody else is expected to join as part of ServiceNow. So our goal is to really combine the efforts and really accelerate the opportunity and build a multi-billion-dollar cloud security and overall cybersecurity business for ServiceNow.
Before we let you go, Amit, I'm just curious about where organic growth comes from, if at all, over the years. Obviously, ServiceNow historically has done a great job at these tuck-in acquisitions. Is there an organic growth strategy?
Yeah, so I think if you look at all the growth we've been having, and none of that, the Movers acquisition just closed recently. Armis will close mid next year, and a lot of the tuck-ins are just IP purchases. So everything we've been doing has been organically driven. The 20% plus growth we announced last quarter was organic, and we expect to deliver the organic growth we have been promising the street. And so far, last 10 years, if you look at it, 50 plus, rule of 50 plus continues to be intact. And we are very confident that that will be hit continually going forward organically.
Amit, really appreciate you jumping on for us. Congratulations on the deal. We'll catch up with you in 2026. The President, COO, and Chief Product Officer over at ServiceNow, Amit Zavery. When we come back, Stu Leonard Jr. He needs no introduction. This is Bloomberg. Beef. It's used to be what's for dinner, but prices continuing to hit records despite the Trump administration's efforts to rein in costs. Our next guest is having their, quote, busiest week for beef sales, filet mignon sales to be specific, ahead of Christmas Eve and those Christmas Day dinners. Let's bring in Stu Leonard Jr., the man, the myth, the legend, president and CEO of the Stu Leonard's grocery chain. All right, Stu, let's start with this because I've been looking at beef prices, man. They're high. You telling me this is affordable, or at least I should be buying it for Christmas?
Well, you know what, Romaine? You probably hit on the hottest item that's up in price right now. I mean, this is what we're selling right now. This is a filet mignon right here, $22 a pound, okay? I haven't seen that in the 50 years I've been retailing. But when I talk to our ranchers out in Kansas and the Midwest, one of the things, the herd sizes in America are the lowest they've been in 50 years. So it's a supply and demand issue. They're starting to raise more cattle now. We should see in the future prices come down on meat.
So it gets to this idea then, and I know we spoke, I think, right before Thanksgiving, and you talked about this idea that, particularly on holidays, people are willing to spend as much as they think they'll need to spend in order to have that sort of perfect holiday, that tradition here. Are you still seeing that carry over now?
You know what's interesting? We're seeing people spending right now. I mean, our catering, they want to save time right now. Get it done for me. Our delivery even to people's homes is way up. So people want to save time, but they want really good quality. One of the things I could do, I could save money on my meat purchases. I could buy from Brazil. I could buy from Argentina, from Canada. I could get a lower price, but the quality is not as good. Customers don't want to sacrifice quality this holiday.
And Stu, you mentioned that, this is a time of year where people want to spend, and it sounds like you're seeing that. When it comes specifically to beef, the fact that people seem to be willing to reach into their pocketbook, does it then follow that they're willing to pay up at Christmas time to buy that beef rather than maybe trade down to a ham or a chicken?
Well, that's interesting. We do see chicken prices actually have come down right now. So we do see some switching off. But, your traditional dinner right now is that rib roast, that filet mignon. And it's amazing, even though, as you mentioned, Romaine, price of this has gone up from $22 for $29. You get prime, okay? So prime beef is that's even gone up 20% this year in sales right now. So you're sort of scratching your head a little bit. But you want to know what the poster child is? These little guys right here.
Let's see.
These are Alaskan king crab legs. Those are gigantic. Aren't they? They're gigantic and delicious. And last year we sold them at $49 a pound. Now, I don't want to, we're not an expensive store overall, but this year, just to get them, because the demand is so high, we're retailing it for $89 a pound.
Wow.
So that's like a sticker shock. But here's the good news.
Yeah.
Eggs, yay, yay, yay. Eggs are down.
Eggs.
Okay. Yay, yay, yay. Butter's down.
Butter's down. All right.
Okay. Milk is down.
All right.
Okay. lobster tails. You want to have your filet mignon with a nice, beautiful lobster tail from the Gulf of Maine. There it is. Right there.
So, Stu, let me stop you right there, because you're getting all the fancy stuff, the lobster tails, the crab legs. Talk to me about something that's going to make Katie angry.
Probably.
The cookie milk. Now, I am a huge. Is this back? Is this back? Wait, let me see it. All right. I don't think Katie even knows what this is. All right.
What is that?
It's exactly what it sounds like, Katie. Explain to Katie what cookie milk is.
Well, listen, here's the thing. First of all, it tastes like creme brulee. It's got a really beautiful flavor to it, and it's delicious. We sold it last year, but this year sales, we're going to sell 40,000 bottles of this. And you know why? Just because it's TikTok. It went viral on TikTok. There's 20 million people that are watching the post. We're shipping it all over the country. People are gobbling up 2, 3, 4, 5 bottles. What happened? I don't know. But it's one of the phenomenons that has happened this holiday season. Is Stu Leonard's cookie milk. How?
There you go.
TikTok.
Yeah, well, now that we're talking about it, it is for certain going to pop up on my TikTok later tonight. But Stu, I am really curious to talk about Thanksgiving and look behind us, because my family, I'm going to say it, we catered the sides. But taking a look at some of the notes that were sent over to our producers, it sounds like my family wasn't necessarily alone there.
As far as ordering your whole meal out, that was a big increase. Like I said earlier, people want to save time at the holiday. They want to have their holiday dinner, but they don't want to, mash all the potatoes up and cut all the vegetables and cut the fruit bowls, So we're doing all that work, and that's one of the reasons that's putting pressure on food prices across the country right now, is the labor rates have gone up, and we're seeing a strong, big increase in energy right now. All our farmers, even us at the retail level, are trying to balance that and really hold prices as low as we possibly can. Nobody wins when you raise prices. Our importers, our suppliers, our farmers, even our family here at Stu Leonard, you don't win when prices go up.
Right. All right, Stu, always wonderful to have some time with you. Happy holidays to you and your family. That is Stu Leonard Jr. He is the president and CEO of Stu Leonard's. And I have to say, we did make the turkeys.
Yeah.
They were okay.
I'm glad, because you kind of scared me with this, you're catering the sides. I want to do, maybe we can do this the next time we're on together. We're going to have a taste test.
Yeah.
I want to do cookie milk from Stu Leonard's, traditional eggnog, and coquito.
What is coquito?
It's like Puerto Rican eggnog. It's like without the eggs, a little coconut. It's really good.
I have to imagine I'd like just the plain eggnog the best. I know that you're a big eggnog guy, but that sounds like a really fun idea. Maybe
I gain 36
do
pounds every Christmas.
It's wonderful. Let's take a look at how the market's
Between that
closed.
and the peppermint bark, Katie, come on.
Yeah, I don't really like peppermint, but I do like to see the S&P 500 finishing the day about 0.5% higher. We can't necessarily say the same for
Who
Bitcoin.
doesn't like peppermint?
It just reminds me of
so refreshing.
Taste. Yeah, that's the thing.
You had the wrong one.
Yeah, maybe.
Okay.
Anyway, gold and copper. Really interesting conversation earlier, that the fact that copper a bet on growth, gold a bet on theoretically a haven, but it's been acting really like a risk-on asset lately. Anyway, this is the close on Bloomberg. Well, the secondhand fashion market is growing at 3 times the rate of the market for new goods, according to a recent report from the Boston Consulting Group. Now, that same report estimates that the global secondhand market could reach a value of $360 billion by 2030. Joining us now to discuss is someone who knows the space well. His name is Ben Hemminger. He is the CEO and co-founder of Fashionphile. It's a company focused on the ultra luxury resale market. Ben, it's great to have you with us. Talk me through how you source your items. When we're talking about ultra luxury, scarcity creates value. So how do you actually bring them to your site?
Thank you for having me. It's a great question. How we bring them to the site is through interactions with people like yourself, or in people who have bags themselves that they've bought. So we buy them directly from individuals, from their closet. Make you an offer, kind of a cash offer, direct buyout up front, and then you send the bag in, and that's how we get our inventory. So in order, to source all this great stuff, we have to have great relationships with handbag owners and jewelry and watch owners throughout the country.
And how do you differentiate yourself from, a Real, for example, which seems to offer something similar and that competitive landscape? I mean, how do you, attract those folks that you need to have that relationship to come specifically to Fashionphile?
Yeah, I mean, one, we're specialists in handbags and accessories. So the ultra luxury brands, those classics, Chanel, Louis Vuitton, Fendi, et cetera, we only do accessories, and we're experts in authentication. But there's another separate, differentiator I think is really important to the customer is the direct buyout. So we actually offer money up front. So you don't have to go through a consignment process or wait for it to sell before you know how much you're going to get. We'll just give you the money up front, say here's your $2,000 or whatever, and you can go away and be done with it. Or so that's one unique differentiator is that specialty, and our specialty allows us to make really accurate direct buyout and take the risk ourselves of having to resell it.
So Ben, I'm curious if you could just kind of talk about just kind of broader trends in this space. The idea that you have secondhand goods has sort of taken on a cachet that didn't always exist in the past. I mean, there's always been thrifting, always a certain cohort of people that were always willing to do that. But the amount of people, the percentage of people who are willing to sort of traffic in this space is really just phenomenal compared to what it was, 20 or 30 years ago.
Yeah. I mean, we have noticed that, and we've been doing this like 20 some years, so we've kind of seen that change in the customer. What the thing has happened is the customer has kind of realized all the benefits of pre-owned that maybe they didn't before. Like, it's not only there's a price benefit, but the optionality, the choice of all the different colors and styles that have been released over the last many years are all available today. And there's a circularity component. I think customers are prioritizing some of that sustainability and the circularity, and they're realizing they have value in their closet and they can use that value to buy the newest things and just kind of keep refreshing. So I think it's just they've realized how fun it is, how much choice they have, and how much their bag buying buck just stretches so much more when you're trading in and trading up constantly.
I am curious, have you ever received any pushback from some of the luxury brands themselves? I mean, how do they feel about all of this?
Yeah. Not a direct pushback necessarily. We look at the brands as something like we need them, of course. We want customers to keep buying straight from those brands, whether it's Chanel or Hermes or Louis Vuitton. We want them to buy that because that's how we get amazing things. They buy it and then they sell it to us. And we think the brands do well with us in the market because we're putting money back into the hands of people who clearly are bag buyers. And so I think we're fueling some of that, the buying cycle to happen even faster. So there's quite a good synergy between the brands and us. There hasn't been a lot of pushback that we've noticed lately.
Well, Ben, something I always wonder when it comes to luxury resale, ultra luxury resale, is how do you authenticate that the bags that are coming into you, how can you verify that they actually are some of the brands that you're talking about?
Yeah, I mean, that's kind of part of the secret sauce of the business is that we have a team of trained authenticators who don't do anything except for handle each and every bag that comes in with, a loop and sometimes an x-ray and, using technology and experience to look at all the great, the leather quality, the stitching, the smell even. And we just have trained experts that have years and years of experience looking at thousands of bags. And that's kind of like one of the, the reasons people shop from us is that trust and authenticity. And it does take time and a lot of training to get people up to be able to have that level of expertise.
All right, Ben, I think that's a great place to end it. Really great to have you on the program. Ben Hemminger, CEO and co-founder of Fashionphile. And of course, when we talk about this broader trend of consumers warming up to some of those pre-loved items, it's also been a trend that's been fueling the sales of collectibles. I had a chance to get a glimpse into the forces powering that market with a legend in that space, Ken Goldin. And he brought along with him entertainer, entrepreneur, and, WWE athlete Logan Paul to talk about season 3 of Goldin's show, King of Collectibles, which features Paul as a celebrity guest, and it features a very, very expensive item up for sale. Take a listen.
I love the show, King of Collectibles, The Golden Touch. This is our 3rd season, launched today. It's, takes you into the incredible world of collectibles, the value of the items, the history behind it, the story of the chase, the excitement, and also the personalities that collect the items, that buy the items, and why collectibles are so incredibly important. It's a fast-paced show, and I love doing it. I hope I'm doing it 10 years from now.
Well, you talk about personalities. No one's a bigger personality than Logan Paul. You seem to be clutching your chest right now. Is that because you're wearing a very expensive jacket?
Yeah, the jacket is expensive, but that's neither here nor there. No, it's because I have the most expensive Pokemon card around my neck, and let's see it. Superman.
Oh my God.
The one-of-one PSA 10 Pikachu Illustrator that is on season 3 of Ken's show.
The most coveted card in the world.
Absolutely. So those folks who aren't Pokemon experts, I mean, you famously bought this card back in 2021, the most expensive one ever. And this is a rarity. I mean, these cards weren't really sold. They were just kind of given out, right? And at some point, you managed to get a hold of one of the few, not only just intact ones, but I'm pretty sure this is the highest rated one out there, too.
Yeah, it's the only one in the world. It's a PSA 10, meaning it's perfect.
Yeah.
And like I said, it's one of one. Like you said, it was one of 39 copies handed out in 1998 for a Pokemon illustration contest. So this card couldn't be bought. It was earned, which is part of the reason why the lore contributes to such a high value for the card.
When you paid what, by most reports, is upwards of $5 million for this. There are a lot of people that said you're an idiot.
Yes.
Like, what is he doing? Who would pay that much for a card? Now, I'm told that you're actually willing to put this back onto the market. You think you're going to get more than the $5.3 million that you paid for it?
Look, that's honestly always the goal, right? Yeah. But I actually say willing isn't a great word. I had to be convinced to put this card at auction. Ken has chased me for years trying to convince me to sell the card. And let's be honest, the Pokemon market is as hot as it's ever been right now. And those people who thought I was an idiot, I think I'm the one laughing in their face now, because Pokemon has delivered higher returns than the stock market in the past 20 years by upwards of 3,000%. And so while I think this will probably go for more than I bought it for, it's an auction, but it is the best card in the world. There's nothing like it, and it's a piece of history now. I wore it out to my WrestleMania debut. It's on Ken's Netflix show, and I think we're excited to see what it can go for.
And it's funny you bring it up when we talk about this idea of collecting. Just let's start with art, right? That was what, if you had a lot of money, you bought your Monets, your Jackson Pollocks, things like that. There was sort of this wave a few years ago of this younger generation coming in, Ken, as you know, that were much more interested in things like Pokemon cards, Magic the Gathering cards, sports memorabilia. And a lot of people kind of scratch their heads, what's that really worth? Comic books, hip-hop memorabilia. It's really expanded. Talk about how that's expanded your business away from the more traditional collectibles that we think about.
Sure. What you have to realize is that collectibles as a category right now is an asset class. It is an alternative asset class. And while maybe in 100 years ago and also in the 1930s, 40s, 50s, 60s, collecting art, whether it was Picasso, whether it was Renoir, whether it was Monet, Warhol, to go more recent, was what the quote super rich did, and that was the traditional collectibles. People who grew up worshiping athletes, and people of a little younger than me who grew up on Pokemon, which has its 30th anniversary in February this year. They did not grow up dreaming about owning a big art collection, and as they get into their 30s and 40s and 50s and late 20s, they have a lot of money. So to them, owning the best of the best, whether it's a Pokemon card, whether it's a game used jersey, whether it's a sports card, that is what they aspire to be. And that is how we can see something like a basketball card with pictures of Michael Jordan and Kobe Bryant sell for $12.5 million. That's how we can see a jersey worn by Babe Ruth sell for $24 million. That's how I can sell a baseball that was hit by Shohei Ohtani for $4.4 million, and that's how we can see, the Pokemon Illustrator, the single best card out of the entire Pokemon genre, which is the world's biggest franchise, sell for 8 figures.
All right, season 3 is out now, or coming out now. What else is next for you and Logan?
Well, we have as people will find out by watching the show, we have planned together what we believe will be the biggest TCG trading card game auction in history. The Illustrator is going to be the anchor, and there's going to be millions and millions and millions of other dollars, of other items, Pokemon, Magic the Gathering, and similar items. And we're going to have the auction is going to launch in January. It's going to close February 15th, and timing it for the 30th anniversary of Pokemon. And that's something that, we're looking. My worst case scenario on that is 15 million. I'd love to do a 25 or 30 million dollar auction with that, and that's really, to me, a big event for the industry. Mm-hmm. I can tell you what's happening for the industry right now. Over the past 6 weeks, I've been contacted by multiple firms that are either in existence or just starting up or want to start up to have, basically funds dedicated to collectibles.
When you say funds, like
a gold fund or a crypto fund, but a collectible fund. And whether it's $50 million or $250 million.
Why haven't we seen that? I mean, or something like even an ETF or something.
Well, that's exactly what people are looking to do for now. There is one company out there that is doing it. They're doing it solely with basketball cards. These people want to do a more broader basket, and as probably hobby-wise the most well-known guy. They're coming to me and asking for advice, but I think that is really going to take the market to the next level.
And you think that's possible? I mean, with regards to the regulations, you think they would sign off on it?
There's one successful fund that's operating right now, and but it's very private, very closely held.
Sure.
But I do think that there's so much opportunity. I expect that to happen.
And that's collectibles legend Ken Goldin there alongside the entertainer entrepreneur Logan Paul, reminding us once again, Katie Greifeld, that everything apparently comes back to ETFs.
Yeah, ETFs. I thought you were going to say Pokemon. I'm surprised, that Pokemon just won't die. People love that stuff.
People love it, and now you talk about the value of some of these cards. I mean, like I said, the one he was wearing, he paid $5 million for that. He basically saying he thinks he can get maybe upwards of $8 million, even more for that as well. And it's not just that. I mean, they had all these other items that they talked about that, like I said, would have just been like, collecting dust in someone's attic.
He should take that off the necklace and put it in his pocket. That makes me nervous.
Well, let's just to say, he's a very big guy, and he had an even bigger guy with him who I'm pretty sure was armed. So I think he's okay. All right, we'll be back in a moment. We'll set you up for what to watch over the next 24 hours. All right, let's set you up for what the markets will have their eyes on for the next 24 hours, and it will be Christmas Eve tomorrow.
It is Christmas Eve tomorrow. We do get MBA mortgage applications at 7 a.m. We also get initial jobless claims remain at 8:30. That will be interesting.
I'm going to tune in for that. Well, actually, I'll still be asleep probably. But at 1 p.m., equity markets, just a reminder, do close early. 1 p.m. Eastern time.
1 p.m. Eastern, 2 p.m. That's when the bond market joins in. It is an early close because the next day is Christmas.
And then you get to leave after that, right?
Absolutely.
Ho, ho, ho. It's been a wonderful few months working with you, Katie. I will see you in the new year.